Building from that basic info, we've got our valuations, but you're able to actually start creating these metrics that are pretty important. I think we can all agree. Cap rate, cash on cash return, debt service coverage ratio, dollars per square foot, and rent per square foot. Now, I think most of these are pretty self-explanatory. The one that probably has some questions around it possibly is the debt service coverage ratio. The debt service coverage ratio is a downside mitigation metric. It's one that banks typically use. So you may have heard of like DSCR lenders. That's debt service coverage ratio. So what they want to see is what sort of coverage will the net operating income have against your debt servicing. So for instance, if your debt servicing for an annual basis for a self-storage facility is $100,000 and your net operating income, so gross operating income minus expenses equals NOI, your net operating income is $125,000, you have a 1.25 DSCR, meaning that you are 100% covering your debt service, that'd be a DSCR of 1, plus 25% on top of that, because you have $25,000 left over, 1.25. So it's a metric that banks use to gauge risk, because it's saying, okay, you not only can cover the debt payments you have to do, but you also have a buffer. And banks typically want to be seeing a debt service coverage ratio of at least 1.2 within the first 18 months of buying a property. I personally like to aim for 1.25 just to have a little extra buffer there, especially when we're doing the back of the napkin sort of valuations, because we know that those numbers might change a little bit, so we're baking ourselves in a little cushion. Additional basic info that we want to collect. So if the call with the seller was only 10 seconds long, and I say, gross operating income, net rentable square foot, we'd be all right. But if I can squeeze out a little bit more information when we eventually have that conversation where we're getting into some details, I'd love to know the occupancy percentage, because then I can answer the question of can we raise occupancy or raise rates based on occupancy. If they tell me that's 100% occupied, that tells me that either we can raise rates, or if it's already at market rates, then perhaps I can expand the facility, which leads to the next one. Is there room to expand? If the facility is stabilized, or once we get it to stabilization, it's always nice to have a little land to expand upon. Even if it's something where I don't expand upon it, it's a value add for the next person. You've got to be thinking about how am I exiting from this facility. That's that downside mitigation mindset. The rent for a 10 by 10. 10 by 10s are the bread and butter. You know, it doesn't matter if you're in a downtown facility or a rural facility, 10 by 10 tends to be the bread and butter, because in more densely populated markets, you're looking at smaller units being more popular. In less populated, more rural markets, larger units are typically more popular. 10 by 10 is right down the middle. So I don't need to know every unit size you have, every unit rate you charge, but if I know what you charge for a 10 by 10, I can then go look at other facilities in the area, find out what they're charging for a 10 by 10, and then gauge that to see, are you in general going to be above or below what market rates are?